So for me, I'm not convinced yet that the winter is over yet. I think it's almost been too easy of a winter in respect to, yes, we've seen big declines, but we still have a massive amount of crypto coins out there that have no use case, no real reason to be in existence, and they're still in existence, and they're still getting pumped on a daily basis, right? In fact, recently, Pepe and all these other ones, it's just flooding the market and going up ridiculous amounts. So I'm a little concerned about that. To me, the 30,500 level continues to be the level on the charts that I'm keeping an eye on. So if we just take a look at the chart right here, right?
Yep.
And we just kind of we can see that the Bitcoin chart ran up to that 30,500. It collapsed back on it, below it. We've now come back up a little bit because of the fear in the banking markets and so forth. But for me, this level is the key level, this 30,500 level. Can we get through that? If we do get through that, then I actually think the low is likely in on Bitcoin at 15,700. But again, I would just caution people, at this point, you look at what Bitcoin has gone up and you look at the 2018 and 19 bear market, it had bigger rallies than this in percentage terms during that bear market. And people, again, seem to forget that. So don't be fooled. I've been through many bear markets in commodities, in the stock market, in crypto in my trading career. And sometimes it turns out to be the lipsticks on the pig here, and it could still roll over and head lower. So I still think there's a chance for 12 to 13,000, maybe even 9,000. But again, that 30,500 level is the level I'm watching.
Bitcoin set aside its concerns about renewed banking unrest and slowing U.S. economic growth to hold comfortably above $29,000 throughout U.S. trading hours on Thursday. The largest cryptocurrency by market capitalization was recently trading at about $29,500, up roughly 2.2% over the past 24 hours. BTC topped $30,000 at one point, near its earlier week highs, but still well off its April peak, close to $31,000. Still, investors seem to have forgotten Wednesday's dramatic seesawing when the crypto dipped to around $27,200 amid a mass liquidation of short and long positions and separate unfounded rumors of Bitcoin sales by the U.S. government and of crypto from failed exchange Mt. Gox before rebounding. Hello and welcome to Money Talks. In today's video, founder and chief market strategist at InTheMoneyStocks.com and verified crypto investing, Gareth Soloway updates about Bitcoin's current market standing, the final bottom in crypto, and his outlook for Bitcoin in 2023.
Yeah, so I think the market, we see upside today, pretty solid upside too in the S&P 500, the NASDAQ 100's having a monster move. Part of that's on the back of the Meta earnings. Obviously, we had the earnings yesterday from Microsoft as well. So very good earnings news, as you had mentioned. But I think the lower GDP numbers are keeping the market and investors focused on the very near-term benefit of the Fed potentially not hiking or not hiking as much. And I caution the market. I caution investors when I see this, because ultimately what we know is that when GDP starts to slow down, we might actually turn negative, and it could dictate that recession is a looming indicator, or that we're likely headed towards recession in the second half. So I think the market itself is rejoicing, saying, okay, a weaker GDP number means, hey, the Fed may not have to hike as much, or maybe can be a little bit looser on their monetary policy. But I do caution that ultimately, if we spin into a recession, the Fed is not going to be able to lower interest rates much because inflation is still elevated. I do still think that. I think the Fed is still focused on not becoming the Paul Volcker of the 2020s, if you will, in terms of being too loose on monetary policy, maybe getting too dovish too quickly, and then letting inflation roar back. So I think we will see 25 basis points. But again, this should give investors concern, because if we're already seeing economic news, and again, we saw the jobs data a month ago or so starting to come in a little bit lighter than expected. Now GDP is showing a marketable decline from what was expected. You have to start saying, okay, is this an indicator that we are headed towards that recession the Fed's calling for in the second half? They're saying mild, and I think we talked about this before, but they said transitory, and look at what the outcome was. So I don't really trust them when they say mild for a recession. I do think so. And I think the
Okay.
markets will probably initially rejoice at it until they start to think about, okay, if the Fed is pausing here, what does that mean economically? What is he seeing on the horizon? But I think initially the reaction is, I mean, investors are very much in the buy the dip mentality again. You can see it in crypto. You can see it in tech stocks. Every dip is being bought. We're floating back up. Then we get these big earnings. So I think the market will initially react positively to that. And then I think over the coming days and weeks, that's where the market starts to see some profit taking.
Since spiking approximately 40% in January, Bitcoin and other cryptos have been stubbornly resistant to industry mishaps and wider macroeconomic uncertainty. U.S. equity markets rose as surprisingly strong earnings from tech giants Microsoft, Google, and most recently Meta trumped concerns about unexpectedly sluggish 1.1% growth in first-quarter GDP and the struggles of regional bank First Republic. The tech-focused NASDAQ Composite and S&P 500, which has a strong technology component, climbed 2.4% and 2% respectively.
Yeah, so I'm still in the camp that we're in for a very sharp decline in the markets. And the reason I say that is twofold. Number one is that it's almost going to be impossible for the Fed to loosen rates to the amount that will be needed to get massive amounts of money to flow back into the equity markets and push us to new all-time highs. So again, if we think about it like this, right, how much did Powell raise interest rates from the start of this hiking session or season? And ultimately, how much is the market up or down in that period? And yeah, we've kind of stabilized. We've inched up a little off those lows, but the NASDAQ and the S&P are still well off their all-time highs. So the question is, how does he come to the rescue of a market when inflation remains north of 3%, 4%, 5%? And even again, I still think inflation is going to continue to come down. I just don't see it getting back to 2% where he can marketably drop those interest rates back to the levels they were at pre-hiking process. Think about this. If they call for a mild recession and it turns out to be a very bad recession and we have 3% inflation, I would absolutely agree that at that point, the Fed will have to come out and hike rate or lower rates substantially. The question is, at that point, what is the discount in the stock market? I mean, if we see, again, a deep recession, what are the earnings looking like for companies like Apple? What about, Microsoft that just reported that was very good? But if we do get in that deep recession, where are those earnings? Where's that multiple for the S&P 500? One thing I'd love to show you guys, and again, this is going into some charts here, but this is one of the most powerful things that honestly has me somewhat spooked, is that if you look at this chart of the S&P 500 that I have up, look at the run-up we saw from COVID, the decline and this sideways consolidation. And then what I'm going to do here is I'm going to throw up this chart, which is the market psychology chart. And in this chart, right, you see the same incline right here from COVID all the way to the highs. If you look, you had the optimism, the belief, the thrill, the euphoria. Then you had the decline. And then look at what this chart is showing you. And look at it in perspective with what the S&P is showing us. And it's almost identical, like literally identical to what we've seen in the market. And if we look at what comes after this complacency period, which I argue we are in, absolute complacency, you get into this big downward move, anxiety, denial, panic. It's the cycles of a bear market. And again, to me, that is unbelievably scary when you look and compare it to this chart here and how accurate it is in falling. Remember what we just looked at. If I put an arrow in here, this is your next move in the market. The biggest move of the bear market is likely on the horizon.
Investors will now be focusing on next week's Federal Open Market Committee, FOMC, interest rate decision. The CME FedWatch tool is currently showing an 87% probability of a third consecutive 25 basis point rate hike, although Edward Moya, senior market analyst for foreign exchange market maker Owanda, wrote in an email that the U.S. central bank is close to ending this type of monetary hawkishness. The Fed will be able to move forward with one, perhaps two more rate hikes, but then that should be it, Moya wrote. Today's economic data painted a picture of an economy that is slowing down, inflation is temporarily accelerating, and the labor market is softening.
Biggest issue with First Republic was they announced earnings and they announced that they 40% of deposits had exited the bank in the last quarter, which is a horrendous number. But honestly, a lot of us expected a bad number. We know how much it dropped going into earnings and so forth. But to me, the kicker was when they came on the conference call, right, they literally didn't take any questions. It was 12 minutes long and they walked right off. Like if I was JP Morgan and I just put in $30 billion with a bunch of other banks, I would have been pissed. right? Think about that, right? Here it's a destabilizing impact to have them walk off that stage, and you just gave them all this money. It's like the least they can do is answer questions and kind of calm fears in the banking market, and they didn't do that. And again, their stock got rightly punished because of it. It doesn't show management's on top of things at all. Not only did they screw up with risk management, but now they can't even handle a simple calming conference call. I do. I still think that there is a lot of issues there. Ultimately, we're going to find out that most likely the Fed will have to come to the rescue at some point in the future. I don't know if that's in the next 12 months, but inevitably, the way it's been structured, our system is now totally reliant on the Federal Reserve and to some extent the government overall to continue to print money so that we can pay our debts and pay the interest on our debts. And that just is an unsustainable thing for our country as a whole and for the debt situation. So we're seeing more and more that more countries are now trading out of dollars. They're not trading in dollars anymore. More and more digital yuan is being traded as a reserve currency. And that will continue. I don't think, again, it's something like the de-dollarization type stuff is not something that I'm focused on today to make a trade on today, but it's something that in the back of my mind, looking at a macro picture, you have to be fully aware of what the longer term trend is here.
So what are your thoughts about Gareth Soloway's prediction? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.